Hey everyone, today I'd like to take you through the final phase of the accounting cycle, which is something called closing the books. So I'm going to take you through this note super quick. You can look through it obviously on your own, but I do want to explain what we are doing when we are closing the books. So I'll just do it in this view here, and then we'll kind of go from there. All right, so we've done the first components of the accounting cycle already in our course: journal entries, ledgers, trial balance, adjusting entries. We've done our balance sheet, statement of owner's equity, income statement. Remember, income statement goes first. But what we need to do now is these last two parts here. So we need to close the books, and then we need to do a post-closing trial balance. So the reason why we close the books, it's really quite simple. Let's say it's New Year's Eve, December the 31st, and your business has earned $5 million for the year, and you had $2 million in expenses, and the owner took out $100,000. When you flip over to the new financial year, so let's call it January 1st for this company, they've earned no revenues, they've had no expenses, and the owner hasn't taken any money out of the business. So what we need to do is we need to reset those accounts, our revenue accounts, expense accounts, and our drawing to zero balances for the new year. Now, if we think of our assets, they still exist. So if we had a $50,000 bank account, that $50,000 is there on January the 1st. If we have a mortgage of $300,000, it still exists. And the owner's capital still exists because the owner is still investing in the business. So we have permanent accounts. Those are our balance sheet accounts: assets, liabilities, and equity, with the exception of our drawings, which is temporary. And then we have temporary accounts, which is our income statement accounts of revenues and expenses. So the steps we're going to take to close our books is we are going to, we're going to close our revenue into capital. Don't worry if that doesn't make sense right now. I'm going to give you an example in just a moment of what that means. But we're going to turn our revenue accounts into zero by dumping all of the revenue we made for the year to the owner by giving it to the owner's capital. We're then going to do the same with expenses. We're going to dump all the expenses, and that's going to bring down our capital a little bit. And finally, we're going to close the drawings, which means we are going to make sure that the drawings are at a zero balance as well. So those are the three steps, the three journal entries you're going to see. And once we're done, we are going to do something called a post-closing trial balance. What the post-closing trial balance does is it brings us back to the very beginning of our course, where we have a balance sheet that has assets, liabilities, and then under owner's equity, we only have a capital account because there's nothing else that exists in the business. And then that accounting cycle that I showed at the start of this note starts again. We have transactions, we start to earn revenue, um, we do journals, ledgers, adjustment entries, financial statements, etc., and then we close the books. So that's a real quick recap of the note that you are going to see. Now let's go to a specific example here. So in this example here, we have a company. So if you look here, this is the trial balance. It's all kind of condensed because I wanted to fit it onto one screen. But the trial balance is something you will see like this, or you may see it in an 8-column worksheet form or a 6-column worksheet form when you are doing your work for me. Either way, it works the same. So in the trial balance, this company has a total of $185,000 in debits and $185,000 in credits. I want to highlight here in green, these are your permanent accounts, which means once the new year hits for this company, so once, in this case, January 1st hits, the company will still have cash, receivable, supplies, land, building, accounts payable, mortgage, and the owner will still have capital in the business. These accounts below are temporary and must be closed. And the reason for that is they need to have zero balances to start the year because we will have not earned any money. The owner took no money out, and we haven't incurred any expenses yet. So here's how you do it. And there's a really easy way, a good check when you're doing a trial balance to see how to make something zero. I could do a T account here. We know I'm going to take these colors away for just a moment. So we know to close drawings or to make drawings zero, in the T account it would have a debit balance. So if we do $3,000 to credit, it's going to turn into a zero. For our sales and fees earned, they have a credit account, so to make them zero, we just simply move them over to the debit side. and they will balance out. So if we have 55,000 on the credit side and then we just add 55,000 to the debit side, the balance is zero. But where do we put that money? That's what we probably want to know, and I will show you how. So here are the 3 steps you're going to do when you're closing the books. So the date is December the 31st, and I want to look here, because even I get confused, and I've been teaching this for 20 years. So my sales and my fees earned have a credit account. So to make it a 0, I'm going to have to debit them. So I'm going to put $55,018,000 here. And I'm going to put in sales and fees earned. And I'm not done yet. So where's that money going? It's revenue, and this is where things start to click in here. If I give it to my owner, then the owner has earned money for the year. So the revenue belongs to the owner. So let's just give it to the owner. And we know that capital increases with a credit. So in this case here, I'm just going to use a formula. I'm going to add these 2 numbers up. Revenue was $73,000 for the year. That now belongs to the owner. So I've officially given the owner the $73,000. And at the same time, I've turned my sales and fees earned into a 0 because there's no money left anymore. We've done a T account, and we've dumped and closed our sales and our fees earned. So now sales has a 0 balance. Okay, close the year. And then on the 31st, we're going to do the same with our expenses. This time when I look at my expenses, they have a debit balance. So obviously, I've got to credit them, and that's going to balance out those accounts to 0. So in this case here, and expenses take away from the owner because the owner's money has to pay for these expenses. So it makes sense that Clark Capital is going to be debited something. We don't know what it is yet, so I just do this. Advertising expense. Salaries expense. And then utilities expense. I'm just going to put these numbers in. 5,000, 7,000, and 3,000. In my head, I know that's $15,000, but I'm still going to do the math. So equals sum these up. And it's 15,000, and no, I don't want to autofill. So then I say to close expense account for the year. And then the final thing I want to do is I want to give the owner the drawings, or I need to take away the drawings from the owner. So it's going to be M bar capital. It's going to be drawings, and it'll be for this $3,000 here. So what I've done is I have dumped the revenue to the credit side, so the owner gets it and it's good for the owner. And then I have taken away the expenses and the drawings, which bring down the owner's capital overall. And all I'm left with is assets, liabilities, and owner's equity. So I'm going to take this color away now because I'm just going to show you very quickly the last step we do. So now we do a post-closing trial balance. And these are the only accounts that are going to be left over. And you'll see this isn't going to balance right now. So I'll add these up. And they don't balance out. Well, here's why they don't balance out. It's because we need to now take what we took from the journal and give it to the owner. So I'm going to go equals the original $25,000. The owner's getting another 73 here, so I'm going to say plus the revenue that was earned minus the capital that was taken away for expenses minus the drawings And my new updated capital is $80,000. All right, so that's how you do it. Those are the three entries you're going to do for your closing entries. And what will happen is you will only be left with assets, liabilities, and capital, exactly where we started the course. And we put that in a post-closing trial balance, and that ends the accounting cycle for our business. So that's your tutorial for today. Watch this and use this tutorial as you're working through. Whether you're working through I might give you an 8-column worksheet, so you have to practice on doing the 8-column worksheet that many of you have done so well in your previous work. And then you will do your closing entries, so those three entries: close revenue to capital, close expense to capital, close drawings to capital, and then do your post-closing trial balance, which has your assets, liabilities, and owner's equity. There's no more revenue or expenses to the business. All right, that's it. Take care, everyone. Reach out with any questions.